Welcome to the Opening Bell Report.
Imagine this. You're standing in a completely silent room, and right in the middle, there's this old school wooden keg. It looks heavy, dangerous even. And if you get close, you realize, oh, this is a powder keg. But that's not the scary part. The really scary part is the fuse running out of it. And that fuse, it's lit, it's sizzling, and the flame is getting closer and closer to the barrel every second.
That is quite a way to start the morning. It's vivid, I'll give you that.
It is, isn't it? But I'm not just being dramatic. That's the exact image, the exact high-stakes feeling we're dealing with today. We're not looking at some boring spreadsheet. We're looking at a situation our source material calls a massive signal flashing red in the background.
It really is. Today we're digging into a company I think a lot of people have heard of, but maybe haven't, looked under the hood recently. We're talking about SoundHound AI, ticker symbol SOUN. And specifically, we are unpacking a very pointed analysis from a piece called the Opening Bell Report.
And I have to say, reading through this thing, the tone, it is not your typical polite Wall Street memo. There's no "we cautiously estimate" here. It's high energy, it's contrarian. Honestly, it feels aggressive. It's basically grabbing you by the shoulders and shouting, "Pay attention, you are missing the big picture."
Which is exactly why we're here, to figure out why it's shouting. And I have to give our standard disclaimer, especially with a topic this volatile. We are not giving financial advice. We never do. We're here to be your guides through this specific document and unpack the data points it's screaming about. Because it claims there's this friction, a war, really between two specific numbers, short interest and revenue growth. And that friction is creating a setup for what the report calls a short squeeze.
A short squeeze. Yeah, it's a term you hear all the time on Reddit and Twitter now. It's almost a buzzword like AI or crypto. But when the math actually lines up in the real world, it's a violent financial event. It's not just a price going up. It's a mechanism breaking.
Precisely. And the report makes a really interesting point about timing. It asks, why now? The argument is that everyone is distracted. Investors are looking at the messy balance sheet, the cash burn, the usual stuff. And they're missing this powder keg we started with.
So the core idea is that the market is just looking in the wrong direction.
In a way, yeah. The report argues the market is mispricing the risk. Most investors are looking at the floor, worried about tripping over a crack, while this analysis says you need to look at the ceiling because the roof is about to blow off. So we need to talk about the mechanics of what it calls a bear trap.
Okay, let's get into it. A bear trap. That implies someone's being tricked. Who's walking into the trap here?
The bears. The short sellers. And the jaws of this trap are built around one specific massive number.
What's the number?
29%. Specifically 29% short interest.
29. Okay, let's just pause on that. I think for a lot of people, percentages can feel abstract. If inflation is, say, 3%, I know that's manageable. If it's 29%, I'm buying canned goods. In the stock market, how weird is a 29% short interest?
It is exceptionally high. It's an outlier. I mean, to put it in perspective, for a typical company, short interest in the single digits, maybe 3 or 5%, that's normal. 10% shows some real skepticism.
Yeah.
When you get up to 29%, you're talking about nearly 1/3 of the entire float.
And float is just the shares that are actually out there for people to trade, right? Not the ones locked up by the CEO or whoever.
Exactly. The tradable supply. So imagine 1 in every 3 shares available to buy has been borrowed and sold by someone betting the price is going to crash.
That is a massive amount of conviction. It feels incredibly bold to bet that much against one company.
It is. The report calls it one of the most crowded trades in the market. And that word crowded is so important here. It's a special problem.
A spatial problem? What do you mean by that?
Think of a small room with a really narrow exit door. You pack it full of people. As long as everyone's calm, it's a party. But if someone yells fire, that crowd becomes a disaster instantly. In financial terms, a crowded short trade means if the price starts to rise, even a little, all those people have to rush for the same tiny exit at the exact same time.
And the exit here is buying the stock back.
Exactly. To close a short position, you have to buy shares. So you get this stampede of buyers who must buy, no matter the price, just to stop the bleeding. They're not buying because they like the company. They're buying because they're terrified.
Okay, so that's the squeeze. That's the fire in the crowded room. But before the fire, why is the room so full in the first place? Why are so many people betting against SoundHound? These aren't stupid people. They're hedge funds, sophisticated traders. What are they seeing?
And the report is pretty fair about this. It doesn't just dismiss the bears as idiots. It says they aren't acting irrationally, at least not if you're only looking at traditional metrics. They look at SoundHound and they see negative earnings. They see cash burn. They see a company spending money way faster than it's making a profit.
Right. The classic show me the profit argument.
The bear thesis is basically, this is all hype. The fundamentals are broken. This stock is going to zero. They look at the bank account and say, this isn't sustainable.
And in a high interest rate world, that's usually a pretty safe bet. Money isn't free anymore.
Correct. And that's why the room is full. But here's where the report pivots. It says the bears walked into a trap because they're looking at the past mechanics, not the velocity of the company. The report's counter thesis is that the bears are obsessed with profitability for a company that's in a hyper-growth phase. They've missed the forest for the trees.
Or missed the explosion for the fuse, to stick with our metaphor. So let's look at the bull case. If the bears see a dying company, what does the data say? Is the business actually dying?
This is the catalyst. This is the disconnect. The report states that SoundHound is growing revenue at 120% year over year.
120%. Wow. Okay, let's just sit with that. Doubling revenue and then some in 12 months. That's rare.
It's incredibly rare. A dying company doesn't double its revenue. A dying company shrinks. It cuts costs. It does not explode with 120% growth. And this is the contradiction the report is hammering home. You have short sellers pricing the stock like it's on death's door, but the top-line growth is explosive.
It's like two different realities. In one, the company is broke. In the other, it's taking over the world.
Exactly. And to prove it's not a fluke, the report brings in the competition. It contrasts SoundHound with companies like Cerence and C3.ai.
C3.ai is a name I see all the time. They're kind of the poster child for enterprise AI, right?
They are, but the report is not flattering. It describes them as struggling with slow growth. The implication is that while other players in the AI space are sort of jogging, or maybe even stumbling, SoundHound is sprinting. It claims SoundHound is actively stealing market share, especially in automotive and restaurants.
The restaurant thing is interesting. I feel like every time I go to a drive-thru now, I'm wondering if I'm talking to a person or a very, very polite computer.
And that is SoundHound's bread and butter.
Right?
Or burger and fries, I guess. That's the pure play aspect the report really emphasizes. It calls SoundHound the only true pure play voice AI stock out there.
Okay, I want to drill down on pure play. We hear that a lot. Can you define that for someone who might not know the jargon? Why does that even matter for this whole squeeze setup?
Sure. Think of it like this. Google does voice AI, right? Google Assistant. But if you buy Google stock, you're also buying search, YouTube, cloud computing, Android. Voice AI is a tiny drop in that massive bucket. If voice AI booms, Google's stock might not even budge because maybe YouTube had a bad quarter.
Right, you're buying the whole department store.
You are. But SoundHound is voice AI. That's all they do. So if that sector explodes, SoundHound explodes. There's no other noise. That's a pure play. And the report argues that investors who want specific exposure to this revolution have nowhere else to go.
Scarcity value.
Exactly. And that leads to the valuation, which is where the bears start screaming again. The report notes the stock trades at 30 times sales.
Whoa, okay, hold on. 30 times sales, not earnings.
Low.
That is steep. I mean, usually we talk about PE, price to earnings, but since they don't have earnings, we look at sales. But a 30 times multiple, that's a nosebleed valuation.
It's a massive premium, absolutely. If you're a traditional value investor, you look at 30 times sales and you run for the hills. You don't just walk away, you sprint.
So how does the report justify that? How can they possibly call that a buy?
They justify it by saying the market isn't paying for what SoundHound is today. It's paying for future dominance. The argument is, when you have a company growing at 120% in a sector that is projected to be massive, and voice AI is arguably the interface of the future investors will pay that price for the ticket to ride.
So the bears are looking at the price tag saying, this is too expensive for a company losing money, and the bulls are looking at the growth saying, it's cheap for a future monopoly.
That's the battleground.
Yeah.
And that tension is what creates the coiled spring effect the report talks about.
I love that analogy, the coiled spring. It suggests potential energy, right? Something being held down that wants to pop. But for it to pop, it needs a floor. Does the report see a floor?
It does, and this gets us into the technical analysis. Now, I know you like to joke that this is just astrology for men.
Hey, I'm just saying, sometimes looking at lines on a chart feels a bit like reading tea leaves.
I get it. But in this case, the lines matter because the algorithms care. The machines trading the stock care. And the report points to a very specific line in the sand. It says the stock is holding firm around $11. Specifically, it keeps bouncing off $10.90.
So why is $11 the magic number? What makes it so important?
In technical terms, it's a support level. It means every time the price drops to 11, buyers step in. It's a psychological floor. But for the short sellers, that $11 floor is a nightmare.
Because they need it to go lower to make money.
It's worse than that. They need it to go lower just to stop losing money.
Yeah.
Remember, when you short a stock, you're borrowing shares, and you have to pay interest on those shares.
The cost to borrow.
Right. And for a stock this heavily shorted, that cost can be very high. The report says this is a major pain point. Every single day that SOUN doesn't crash below $11, the shorts are bleeding cash. They're paying fees.
So they're just waiting, but they're paying for the privilege of waiting.
Exactly. And the report suggests there are trigger events that could end that waiting game very violently. It's looking for sparks that could light this fuse.
Yeah, what sends it over the edge? It can't just set at $11 forever.
Well, the report lists a few things. A new partnership announcement, an earnings beat, a guidance hike. So the company saying, hey, we're going to make even more money than we thought.
Basically any piece of good news.
Any substantial good news. And here's the chain reaction. Let's walk through it. Say they sign a big deal with a car manufacturer. The price naturally ticks up, maybe from $11 to, say, $12 or $13.
Okay, standard stuff so far.
Normally, yes. But remember the shorts. At $13, they are now seriously underwater. They are losing big money. Their brokers start making margin calls.
Margin call. The two scariest words in trading.
The broker says, you need to put up more cash or we are closing your position for you. So they have to cover.
And covering just means buying the stock back.
Right. To get out of the bet, they have to become buyers. And remember, 29% of the float needs to be bought back.
That's the crowded room.
That's the fire in the crowded room. Yeah. If 29% of the tradable shares suddenly become forced by orders all at once, combined with regular investors buying the news, the supply of shares just vanishes. There are no sellers left. Everyone is trying to buy. The report says this sends the price vertical.
And what kind of price targets are we talking about? Does the report put any actual numbers on this?
They do. They're aggressive, but they have targets. The analysis suggests a squeeze could send the price from 11 to 15, then 20, and potentially even to the analyst target of $26. And the phrase they use is in the blink of an eye.
From 11 to 26, that's more than double. That's huge.
That is the power of a squeeze. It's not about fundamentals anymore. It's just raw supply and demand mechanics. The shorts must buy at any price to stop the bleeding. They become desperate.
Okay, this sounds incredibly high stakes, but I have to play devil's advocate. This leads us to the section on risk. The report talks about asymmetric risk. What does that actually mean here?
Asymmetric risk to reward just means the potential upside is much, much larger than the potential downside.
So break down their math on that.
Okay, so the report argues that at $11, the stock has strong support. Let's say the bears are right. The company struggles. Maybe the stock slides a bit, as they put it, maybe to $9 or $8. You lose $2 or $3 a share.
Okay, painful, but you survive.
Right. But if the bulls are right and the squeeze happens,
yeah,
the stock goes to 26. You make $15 a share. So you're risking, say, $3 to potentially make 15. That's a 5-to-1 reward to risk ratio. That is an asymmetric trade.
I see. So it's not saying there's no risk. It's saying the risk is small relative to the prize.
Precisely.
Yeah.
And the strategy the report suggests is, well, it's not subtle. It explicitly calls buying this dip a golden opportunity and talks about buying the fear.
Very subtle.
Right. It's a classic contrarian move. When everyone else is terrified, hence the high short interest, that's when you strike. It also notes that the stock chart shows consolidation, meaning the price has stopped falling and is moving sideways, kind of building energy for the next big move.
So to sum it up, the fundamentals are messy, yes. Negative earnings. If you're a traditional investor, you hate it. But the growth is undeniable. And the setup, that huge 29% short interest, creates a situation where the payoff could be huge.
That's the thesis. It's high risk, no doubt. But the argument is that the market has become too pessimistic, leaving this coiled spring ready to snap back.
So what does this all mean for you, the listener? We've unpacked the bear trap, the hypergrowth, the mechanics of the squeeze is a really compelling narrative.
It is, and the report leaves us with one very clear instruction. Watch that $11 level like a hawk. That is the line in the sand. If it holds, the thesis is alive. If it breaks, the bears might be winning.
But if it holds and we get that spark?
Fireworks, exactly. And honestly, watching a squeeze play out is one of the most fascinating things in finance. It's human psychology, math, and fear, all wrapped up in one ticker symbol.
You know, it really makes you think about how markets work. We like to think it's all rational calculation, assets, liabilities, cash flow, science. But this report highlights something different. It asks if we're seeing $20 this year, but the bigger question it raises is about psychology.
It really is. It brings up this fascinating battle. In a tug-of-war between traditional metrics, like earnings, and momentum metrics, like growths and short interest, which side usually blinks first?
Does the cold, hard cash win out, or does the crowd's fear and greed take over?
History shows it can go either way, but when it breaks toward momentum, as we saw with stocks like GameStop, it breaks hard. The math of the short seller forces them to give up. They have no choice.
That's a thought to chew on. SoundHound AI, the powder keg with the lit fuse, whether it explodes up or fizzles out, it is definitely not going to be boring to watch.
Definitely not boring.
Don't forget to like, share, and subscribe for more.